Hi, I'm Greg Wellborn with First Financial Consulting here in Pasadena, California. Welcome to our webinar on successful retirement planning. Before we get started, let me tell you a little bit about how to use the webinar software. First off, we've got you all muted. We can't have 50 or 100 or however many people are in the webinar today talking all at once. But we have made provisions for you to ask questions on the side of the screen, and I want to encourage you to do that. The more dialogue that we get, the better off for everybody. And we're all among friends. No one's going to see who you are or judge your questions. Now, our goal for today is, first of all, to respect your time, honor our commitment to keeping this to a reasonable length. But secondly, give real value and some actionable items. And actually, at the end of the webinar, hang on because we've got a great exclusive offer for you. But even with all that, you may be asking yourself, why should I stick around? Look, I get it. You're busy, you've got a life to lead. I've been in webinars myself where you wonder, really, do I have the time to do this? Well, let me share a little bit about our story. And it's a personal story. Let you know why I think this is going to be of value to you. You see, it starts with my father, and he was a dental surgeon. And now you're asking yourself, what does dental surgery have to do with retirement planning? Well, frankly, he was good. I mean, he was really good at what he did, and people flew in from all around the country. And he was putting money away, and he thought he was doing everything right, and at some point, he was gonna have to retire. It's a very physical job if you think about dentists and dental surgery and how they're leaning over and getting in your mouth and all that. So when he got close to that and really took a look at, where he was relative to retirement, he realized he wasn't all that prepared. So what did he do? Well, he got good at that. He got good at preparing for retirement. So good, in fact, that many of the other doctors in town, also people that haven't prepared, started to ask for his help and his advice, and he started to charge, and voila, a business was born about 1975, 1974. So we've been around a while. Meanwhile, there's me. I'm not my dad. I wasn't a dental surgeon, but I was going to school, went to Occidental College, and then I went for graduate school at USC for studied in investments and finance. And I know right now, half of the SoCal audience is closing down. I'm sorry, Bruins. It is what it is. But I got through with that, and I went to work for a bank and doing pretty much what I'm doing right now, working with clients in similar ways. But then I left the bank. I joined a couple of my clients. I was the head of finance, was the general manager of a division. We did acquisitions, then we got acquired, and I was out of a job. It was a bad economy. Money started running tight. You know the story. Specifics may be different in your case, but we've all been there. We've all experienced that, right? Boring stuff, right? Why am I sharing all this with you? It's not ego. What I'm trying to do is establish a little credibility to let you know that, we've had to make the hard decisions. We've had to reach out for advice. We've been on the other side of this fence. We've had to develop plan A, plan B, plan C. We've had to deal with the family dynamics that surround money. There's real value in that experience that we've got. And we bring that to our clients every day. We know what we're talking about. We're 100% objective. We're fiduciaries. It's another fancy term for meaning we don't sell product, we don't take commission, we don't do anything that distorts our objectivity. So stick around. I promise you there is value throughout. And again, as I said, there's a great exclusive offer at the end. So let's get started. How do you successfully retire? And most people ask that question is, well, how much money do I need to have for retirement? And they usually then answer, well, enough to meet my living expenses, right? Well, it depends. See, that's not, unfortunately, a good enough answer. What we do is have to look at not what are your living expenses right now, not what your lifestyle is right now, but what is your lifestyle going to be at retirement? What additions or subtractions do you want to make to your lifestyle between then and now? What will inflation do to that? Now, if you're not close to retirement, it's pretty obvious. We got to project that forward and take a look at what's it going to look like down the line. But I'd say to you that even if you're on the cusp of retirement, you still have to do that because retirement here in the United States, on average, most people are living 20, 25 years beyond retirement. That's a long time. You still need to look forward. Retirement today may not be, or I'm sorry, lifestyle today may not be exactly what lifestyle is at the end of retirement. You have to make those additions, those subtractions. You have to look at what inflation's going to do. Starting to get the impression that this takes a little work. It's not as simple as it seems. Well, good. You see, some commentators, even sadly some advisors, are tempted to cut this short. They don't like the answer, well, it depends. They want to give you a number. They want to give you a number now. And in fact, they've developed rules of thumb. And I want to look at two of those rules of thumbs in detail to show you why they don't work. But before I get into that, I did a little Google search. I was just curious, how many rules of thumb for retirement planning are there? I got a hit on Google of 100. There are 100 rules of thumb. Look, the dirty little secret in this industry, and I imagine in almost any industry, is these aren't rules. These aren't things you have to do, you can't violate. These marketing gimmicks, more often than not, meant to establish credibility. You throw them out, it sounds great. Well, let's take a couple. Let's dissect them and see whether they work. So I want to look at two. One is the 8 times your income rule, and the other is the 4% withdrawal. So on your screen right now, you've got the 8 times rule being illustrated. So let's say your income right now is $50,000. Well, the 8 times rule says you should have $400,000 in the piggy bank. 8 times 50. But what if you're 30? And what if between now and when you get to 60, 65, your income goes up to 100? Well, then the 8 times income rule would be 100 times 8. It would be 800,000 that you need in the piggy bank. But hey, you thought it was 400, right? Because that's the last time you did the math. Let's be honest. When was the last time you looked at this? 2 years ago? 5 years? A decade? Sound like you? Sound like someone you know? Well, you're in good company because most people don't do this on a regular basis. But let's leave that rule. Let's look at the other one, the 4% withdrawal rule. And the reason I want to bring this up is because it's actually in contradiction to the 8 times rule. Again, we've got another slide and it's kind of illustrating that. Let's assume you get it right about the income. It's not the 50 now. It is going to be the 100 later. And so you've got the 8 times rule and says, got to have 800,000 in the piggy bank. But the 4% withdrawal rule says that you should not withdraw more than 4% per year. Well, 4% of 800 is $32,000. So in your retirement, what is your income? Can you withdraw the 100? That's the 8 times rule, or only the 32? That's the 4% withdrawal rule. That's a big swing. Don't you think that matters? Of course it matters. Do you even know really what your number is based just on these two rules? Are you going to be okay? Or you have to cut way, way back? You're getting the idea that you have to put some planning into this. And retirement planning means just that. You've really got to sit down and plan this. It's not back of a napkin type of stuff. Now, you're smart enough to be asking the questions to be in this webinar, but don't cut this short. See, we here at First Financial Consulting, we do this work for our clients, and we do it 100% objectively. No axe to grind, not selling any products, no commission to compromise our objectivity. And we're going to look at not only income today, but we're going to look at income tomorrow, lifestyle today versus lifestyle tomorrow. What will that be? The one thing we know is it's going to be different. And here again, there are rules, averages that are thrown out. Do not use them, as tempting as they are. And we need to look no further than the Wall Street Journal to see a contradiction at this level. The Wall Street Journal has reported at one point in time that household expenses will decline with age. In fact, the estimate I saw was 34% by age 85. And yet another article at another time in the Wall Street Journal says living expenses will increase with age, largely due to healthcare costs. Which is it? Are expenses going up or expenses going down? Isn't that important to know? Of course it is. The truth, as I said earlier, is that it's going to be different. Up or down, your lifestyle later in retirement, through retirement, is different than it is today. I cannot stress enough the importance of figuring that out. Real retirement planning uses today. It uses raises and promotions that are likely to come. It uses life events. Real retirement planning factors in inflation. Real retirement planning adds in the things you want to do. Do you want to travel more? The things that you don't have to do, the savings that you can take advantage of. Real retirement planning factors in Social Security and pensions. Hey, when we were talking about the 4% rule and the 8 times rule, you never heard about those things because they didn't factor them in. This has to be real. It has to reflect your life, the one that you want to live, your real lifestyle. Great analogy, something as simple as an automobile. Do you want to drive a Volkswagen, a Chevy, or a Mercedes? There's nothing inherently wrong morally or economically with any of those, but they're different choices, different income expense levels. What's yours? That's what's important, is figuring this out. Now, you'd think we have it now, right? I mean, we've kind of identified that it needs to be lifestyle later, and we're going to take a look at what that is. We've got that number. We're ready to rock and roll. Sadly, we're not there yet because you see, we've just been talking about lifestyle. We haven't been talking about total expenses. Total expenses includes taxes. When you're employed, your employer takes the taxes out of your paycheck. You get a net paycheck. And if you're living within your means, which I really hope you're doing, your lifestyle is built around that net paycheck. When you're retired, you've got to write that check. You have to write another check to Uncle Sam. So your total expenses in retirement are your lifestyle expenses plus the income taxes that you have to pay. So let's go back to our $100,000 example. So we got it right. Lifestyle's $100,000 in retirement. But what are your living expenses? Well, the average income tax rate here in the United States right now is 24%. So what that means is if you're living a lifestyle of 100, you need total expenses of 116,000. You're going to have to withdraw 116,000 from the piggy bank, from the nest egg. Give 16,000 to the tax man, and now you've got the 100 that represents your lifestyle. But if you live in a state like California, the average California tax rate is about 8%. Well, that means that for a lifestyle of 100,000, your total living expenses are 147,000. You have to withdraw 147, peel off 47 for the two tax men, and then you get your 100 for lifestyle. There are 5 states that have tax rates in the top that exceed 10%. Where you live in retirement really matters. The slide on your screen shows these United States color-coded by tax rates, the high, the intermediate, and the low. Where you retire is going to make a difference. And I'd like to illustrate just how important that is. This need to be accurate and to figure this out. So on your screen right now is a little chart showing how this plays out. And we've got 3 columns. We have the lifestyle now, 50,000, the lifestyle later at 100, and then of course we have the total expenses, including the tax factor. And we're going to use the 147 example, okay? We apply that 8 times rule. You need anywhere between 400,000, 800,000, or $1.1 million in your piggy bank. If, on the other hand, we use the 4% withdrawal rule, that number would either be 1.2 million or 2.5 million or 3.6 million needed in the nest egg. What's your number? That's a huge swing. 400,000 to 3.6? It's worse than throwing darts at a dartboard. And it's important. If you're wrong, that could be devastating. You need to figure this out correctly, or the rest of the retirement plan is worthless. And the rest of the retirement plan, whatever you've got your number is, let's between 400 and 3.6, whatever it is, let's say we've got it. But you have to ask yourself, do you want more? That's not meant to be a tease. That's not meant to make this more complicated. It's to reflect reality. And we've worked with our clients a lot of years, and we've found that there really are about 3 potential mores that might be added, or at least questions that need to be addressed. The first one is people will state as a goal, look, I just they kind of joke about it. I want to die with my last dime in the piggy bank. So what they'll do is they'll say, let's go out to 110, 120 years of age. I'm going to die before then. So if I've got like a dime left in the checking account at that point, good to go. Because I know I'm going to be fine anytime shy of that. The second goal is to say, no, I want to have a specific dollar amount. I want to know that there's going to be like 200,000 or 300, for pick whatever number that is. But I want to have a specific dollar amount left in the nest egg at whatever age. The third goal is kind of a variation on the second, but it goes beyond their generation, their lifespan. They start to look at kids or grandkids, and the goal gets phrased something like, I want to provide for my grandkids' college education or maybe a home down payment. So now there's a dollar amount that they want, but it's tied not just to their lifespan, but it's tied to maybe their kids or their grandkids. So we've gone out actually further. The point is that knowing your number, which then affords your lifestyle, your total living expenses, in fact, is one thing. But you may want to go beyond that. The goal may be to provide something other than just that it has to grow in addition to providing the income that you want in retirement. I know it's a bit of a circular loop, but I think you get it here, that there are real life goals that you want to drop in. You want to make sure you're taken care of in retirement. You want to make sure that those other goals are being met. So now we kind of know, we do have that number. We know what the nest egg needs to be in order to take care of all that. But how do you build that nest egg? You've got your savings and your investments now, and we know what the tomorrow value needs to be. How do we get there? How do you build that up? Well, typically there are a couple of places where you can put extra savings, put extra amounts of money and build this up. There is a hierarchy. It's not absolute. It doesn't work for everyone, but this does apply because of the specific way these are structured and the benefits. So the first group that I would say is in your employer's retirement plan. These are typically the profit sharing, the 401ks. And the reason they're in a separate group, a unique group, is because they typically allow you to put the most amount of money away and get a tax deduction for doing that. And many of them offer an employer match. So something like your employer says, if you put $600 a month in, we'll put in 300, or it's 500 and they'll put in 200. It's good. It literally is free money. And if you stick around for 4 or 5 years with that employer, then if you leave, you get to take that money with you. Next level down are Iras. And there are a lot of them, and you got to be ready. Here's that laundry list. There are traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs, spousal IRAs, non-deductible IRAs, self-directed IRAs. They all have different contribution limits, different income limitations, and complexities. Next group down, come with a warning: annuities. They are a tool, but they're a dangerous tool. They're dangerous because they can be loaded with limitations and loaded with expenses that offset some of the benefits, and they're oversold. If you tell one of these salesmen, and sadly, sometimes an advisor, I need to do retirement planning, or I've got a toothache, they're liable to come back and say, you need an annuity. So the one warning that I would have, we're not going to cover it here, but if you are considering an annuity, or if you've got one and you don't know what to do with it, we have a great guide that you can get on our website, everything you need to know about annuities. And obviously, we'd be happy to chat with you about that if you want to send us an inquiry. So after that, after the employer plans, after the IRAs, and after the annuities, now we just have what I call your regular taxable investment accounts and even investment real estate. This is just a place we sock money away and it just can continue to grow. Now we get into some areas that come with a maybe. And the first one of those would be the equity in your primary residence. And the reason I say it's a maybe is you have to ask the question, is the house a house, or has the house become a home? Are there emotional attachments to it such that you're not going to want to downsize? If you answer the question, say, look, the house is just a house, well, then great. You can retire, you can downsize, take that equity, put it into the nest egg, and live off the earnings of that. But What if it's become a home? What if this is the place where you want the kids to come back for the holidays, to bring the grandkids? You might say, well, I can just tap into the equity, right? I can take out a loan. What if you can't? What if the banks aren't lending right then, or the rates are too high? It's not as if you can go pull off the shingle, walk to the corner market and say, hey, I'll trade you this for some milk and some eggs. You can build too much equity in the home, and if you're not willing to downsize, then it's not going to do you any good. So you have to answer that question. That's why it's a tool with a maybe. It might work for you, it might not work for you. In a similar vein, there is business value. If you own your own business and you're building that value, you're working hard, but it represents a danger because it's a concentration of wealth. And let's face it, it might not work out the way you think. There might be a disruptor that enters your industry or your market. There might be other reasons that you think it's going to work and it's not. And I can think of two great examples. The first, again, is my father, back to dental surgery. When he started in his practice, dental practices were worth a fair amount of money. Someone entering in, like he did, would have thought, oh, I'll build this up and I'll sell it. And he was pretty good at doing that. But sadly, at least for dentists, dentistry as an industry got pretty good at preventative care, such that at the end, there weren't a lot of people walking around with bad dental problems, and some of the more profitable procedures were decreasing in their frequency. So dental practices were a dime a dozen. When he looked at that, remember, he realized I hadn't done this quite right. He counted on a value being there that wasn't there. The second example, hark back to COVID and the economic shutdowns that came along with that. Perfectly good businesses, my gosh, perfectly good industries, thriving industries got shut down. Businesses shuttered, they closed. Now, this is not to dissuade you at all from counting on business value as being part of your retirement plan, but there is that maybe, that is that risk. You need to be purposeful about diversifying elsewhere so you at least have a couple pools of retirement nest egg, the business as well as something else. Don't just count on it. So however you're putting your nest egg together, whatever you're building it, contributions you're making, you have to do something with it, right? Trust me, you can't just stick this into savings or CDs. The rates at those for those funds are never good enough, high enough, long enough that it's going to grow your nest egg to what it needs to be. And the rate of return matters. And small differences in rate of return make a big difference. The slide on your screen right now shows the effect of small differences in return over time. So what we're going to do is we're going to look at $500,000 and what the effect of different returns is over 10, 20, and 30 years. So what I'm showing is a 1% rate of return, 4%, 7%, and 10%. Notice that the difference between each of those returns is just 3%. From 1 till 4, 3%. From 4 till 7, 3%. 7 to 10, 3% difference. So we're looking at the differences here. Now, if we just go out 30 years, and let's say you're earning a 4% average annual rate of return on that $500,000 for 30 years, you could expect to have $1.6 million in your retirement nest egg. But if you push that out and you earned a 7% average annual rate of return on that same $500,000 over that same 30 years, you'd have $3.8 million, more than double. And if you stretched out a little further and you earned 10%, you'd have 8.7, again, more than double. So as we've moved from 4 to 7, 3% difference, it doubled your money. And then if we moved another 3% from 7 to 10, it's again more than doubled your money. Small differences in return make a huge difference long term in the outcome. Now, I wish it was as easy as saying, hey, I'm going for the 10%. It's not just a matter of greed. It's other things that need to be factored in. Because any of these rates of return might not be good for you. Because every single person is part emotion, part logic, part heart, part head, and we make these decisions simultaneously, and they can really get us in trouble. I want to illustrate what typically happens here. The chart or the table on your screen right now shows you the broad stock market's performance over a couple major ups and downs. And we're going to illustrate what happens. And I'm going to use a quote from a major newscaster from a major network station. And I wrote this down just so I wouldn't get it wrong. At one of these highs, he said, "It's a new paradigm. The old rules of investing don't apply. The sky's the limit." Your average person listening, your average investor piles into stocks. Whether they had any to begin with or not, they pile in. They don't want to miss out on this. After all, the sky's the limit. In this case, just 9 months later, that same newscaster was saying, and again, I quote, "It's the worst recession since the Great Depression. There's no bottom in sight." And your average investor, what do? They get out of stocks. They buy high based on greed. They sell low based on fear. Does this sound like you? Like someone you know? We're honest with one another? The answer is yes. The reason I say that is because I know you're in good company. Lots of people do that. Most people do that. There was even a study demonstrating that. It looked at the stock market over a 10-year period of time, and it just happened that over that 10-year period of time, the stock market earned an average rate of return of 10%. The average investor in that stock market over those same 10 years earned, you ready for it? Drum roll, -2% per year. You heard that right. This greed and fear pattern took what could have been an average annual rate of return of 10% over 10 years and converted it into a personal loss of -2% per year. Without the right plan, without the right knowledge, without the right approach, people will react more often than not to greed and fear. So, what's the solution? A couple of pretty easy concepts: predictability and accountability. If you bring those into the management of your nest egg, you will all but eliminate the fear and greed cycle. What do I mean by those? Well, here's what predictability is. Believe it or not, it is possible to do the analysis and put together different combinations of stocks and bonds and cash, whether it's 50-50 or 70-30, whatever. But we can tell you from those different mixes what the average annual rate of return is going to be over time. And we can also tell you what the average volatility will be, and how much it bounces around that average, and what the really low level might look like in a really bad market. We can give you that information, which is what then allows you to make the right decision. Now you can anticipate the fear factor and figure out, this is where I'm going to be comfortable, so I'm going to peg out this place. Now you got your predictability. You know what you're doing, you know what you're shooting for, you know what the likely outcome is going to be. What do we mean now about accountability? Kind of what the name implies, and most likely what each and every one of you is going through or has gone through in a job. We all get a job description, right? There's the predictability. I want you to do this, I want you to do this, I want you to do this. And then on some frequency, quarterly, semi-annual, annually, we sit down with our boss and we say, well, did you do it? And we get good marks or we get bad marks. Logical, right? Why wouldn't you bring that into the management of your nest egg? And the answer is you should. Most people don't, but you should. You should bring that accountability. You should measure performance on some reasonable cycle, compare it against the goal so that anytime you know, are you spot on to your target? Are you running ahead? You've fallen behind. If you're falling behind, then you know you've got to do something. What are the changes that need to be made in order to get back on target? So let's say you've got your rate of return, you've got your target, and you're willing to commit to that predictability. Well, how do you actually manage the nest egg? How do you actually achieve to hit that target? Use professional management. Don't try to do this on yourself. You see, money management is a real job. It is a real profession. And this is true whether you use an active manager or a passive, an index manager. And I'll explain that in a bit. But essentially, both approaches use professional managers, a man, a woman, sometimes a committee that are making decisions inside of a fund, like a mutual fund, no loads, no commissions, doesn't have to be high cost, but it's just a fund, a pool of money where a professional money manager is deciding how many stocks, how many bonds to buy, which stocks, which bonds to buy, when to buy them, at what price, when to sell them, when to get out, when have they reached the potential of that particular stock or that particular bond. It takes a lot of time, a lot of resource, a lot of research, a lot of money to do this right. You'd be amazed at the amounts of resources committed by professional money managers to do this. You will never be able to match those resources. You will never be able to compete and to beat them. Please don't try to do this. Don't buy individual stocks, individual bonds on your own. Use the professional management. Now, the difference between active management and passive or index management is really essentially the difference between whether you're trying to beat the index or you're trying to just match the index. An active manager, let's say it's in international stock, just to pick one at random, they're going to try to beat the international index, try to buy enough of the international stocks at the right price, at the right time where they can beat it. The passive, the index manager, on the other hand, is going to buy the international stocks at the same proportion that they exist in the index. In other words, they're going to mimic the index. They give you the opportunity to buy into and own the index. Now, many people say that indexing is the way to go, and the reality is that both passive and active, both index and active management, have their places. They're both valid for different people at different times. But because indexing is so trumpeted, it is so spoken and written about, I want to just spend a few minutes to talk about that because you see, it's not quite as simple as saying, I'm going to buy an index. Because not all indexes are created the same and not all indexes are equally good. And everyone's heard about the S&P 500 or the Dow Jones or even large cap growth or small cap, or I'm throwing names out that should resonate with you. It's not quite that simple. There are variations on those themes, and there are some pretty wild ones. And I've written down a couple here. There is the Quant Shares U.S. Market Neutral Anti-Momentum Index Fund. Description is they pair long positions in low momentum stocks with short positions in high momentum stocks. I can't even begin to describe what that is. The next one is the Stock Car Stocks Index Fund. Try to say that 5 times fast. Stock Car Stocks Index Fund. It supposedly tracks NASCAR. It sounds fun, but not altogether profitable. I don't know why you'd want to track NASCAR. But even if you did, it owned, at least when I looked at it, Target and Disney. What do they have to do with NASCAR? Now, my personal favorite to illustrate this point is the Globalx Guru Holdings Index Fund, and I honestly have no idea what this does. I read the prospectus a couple times, haven't got a clue. Just because the word index is being used doesn't make it right, doesn't make it safe, doesn't make it well managed, and really doesn't mean that it will track that particular index. Whatever route that you take, though, passive or active, please, please, please do not do this yourself. Use professional management. Avail yourself of the resources that they have at their disposal, the time that they have spent to master this. Now that I have scared the bejeebers out of you, you're ready to do absolutely nothing, right? We don't want to leave you there. You see, the process for successful retiring is straightforward. You've got to figure out what's your number, how and where are you going to save for that number, what return do you want to, can you earn, and then how do you earn that return? It does sound simple enough, but as the preceding moments in this webinar have illustrated, it really is complex to do. The good news is that it's complex for you. It's easy for a firm like ours. The analogy I want to use is ACL surgery. And now this is one of those rules of thumb that really is true, okay? Too much basketball with the younger generation equals knee surgery. Now, we all laugh, but many of you have been there. And if you really think about how complex ACL surgery is, the training that goes into that, you know you don't want to do it yourself. It's complicated, and yet it's done every day, and it's done as outpatient surgery. What's complex for the novice, for us to do, slam dunk, simple, easy for the surgeon who's done it and done it and done it, and will do it again. Retirement planning is complex, and that's why most people don't do it. In fact, people come into our office and we will typically ask them, do you think that you're on track? And what we get back is, I think so. I hope so. I don't know. I don't think so. No way. I'm toast. You notice what's missing from that list? I'm absolutely on track. Now, in fairness, in all the years I've done this, I heard that once, but that guy was wrong. Look, a solid retirement plan can be done, and a solid retirement plan will determine the lifestyle that's likely to be in retirement. It subtracts the items that you want. It factors in the tax issues, inflation. It calculates the nest egg needed to enjoy retirement, along with whatever other goals you have at the end, and it determines how to build and invest that nest egg. The best people to help you successfully retire are 100% objective advisors, fiduciaries like us. Fiduciary is just a fancy term, but it means that we are both ethically and legally bound to always act in our client's best interest. We never compromise our objectivity. Frankly, we're good at it. We've got 40 plus years of experience, and I don't think I can say we've seen everything, but if we haven't, we've seen a variation of everything. And you can tap in to that expertise and that commitment. Do not try to do ACL surgery on yourself. Don't try to do plumbing yourself. You laugh about that, but at least for me personally, plumbing's a disaster. And last time I tried it, I think I flooded the house. The point here is I could learn how to do plumbing. I could spend enough time, make enough mistakes along the way that I could get as good as the plumber. And finance and investing are very similar. You could get good at it. You could try and put enough time in and make enough mistakes along the way, but those mistakes could kill you along the way. There is real value in the knowledge, the experience, the understanding of those hidden pitfalls. And you get to tap into that by using a firm like ours. In fact, a recent study was able to kind of quantify that value. It determined that using a good advisor could represent a doubling of your outcome over 24 years. That means that if you did this on your own and you could amass $1 million, that using a good advisor, you could amass $2 million. Or if you could amass 1.5, you could get to 3 with a good advisor. There's real value here in using a good 100% objective, a fiduciary advisor. Now, we're at the end of our time and got to start wrapping up, but I want to mention the exclusive offer. We're going to send you an email to thank you for spending time with us, along with a link, and that link is going to take you to our investment questionnaire. Now, if you go through the questionnaire, it's meant to give you some insight into possible investment alternatives and structures to consider. But what we're offering to do is go beyond that. Follow the link, go to the questionnaire, you complete the questions. We will follow up with you, schedule a time to do a deep dive into those results, really interpret them specifically, learn a little bit about your situation, apply it specifically to your situation. It's anywhere from a $250 to $300 value, and we're offering that for free. Again, that will come to you in an email with a link. After that, I still want you to take steps toward a successful retirement. That's just the investment questionnaire. I would like you to also to schedule a retirement planning consultation. It's also free of charge. Look, a successful future is possible. It's within your control. You can achieve it. And using a great advisor means it could be double what you think it could be. And all the times that I've been doing this, I can't remember a case where we worked with someone said, your situation's so bad, you're not going to be able to retire. We've always found a way. Avail yourself of that. We want to help you. We can help you. Call us, email us, go onto the website, fill out a request for a consultation. We're here to help. Now, sadly, we are out of time, and it looks like we didn't get to the questions, but we'll follow up, and if there are any clarifications needed. I want to thank you, though, for attending, and I do want to tell you that we look forward to continuing the dialogue in person with you about the specifics of your situation because we can help you, and we look forward to helping you. So thanks. Have a great day.